My name is Brian Johnson, and I am a former institutional investment manager with over 30 years of experience in the financial markets. I am now a full-time derivatives trader. This is the third and last in a series of videos that demonstrate the use of the option strategy hedging and risk management spreadsheet that accompanies my recent in-depth article of the same name. The 120-page article, which is closer to a short book, presents a comprehensive analytical framework and accompanying spreadsheet tools for managing and hedging option strategy risk. Specifically, the framework can be used to hedge option strategy exits and adjustments. In addition, the framework can be used to identify the most cost-effective black swan hedge solutions using actual VIX call options and actual put options on the underlying security, the SPX in this case. These practical new hedging tools can be applied to any option strategy in any market environment and should be used with all option income strategies. The first video in this series explained how to use the position sizing formulas and the reason why those formulas can lead to large unexpected losses. The second video in this series explained how to use futures to hedge option strategy exits, which greatly reduces the likelihood of those large unexpected losses. Unfortunately, futures hedges alone are not sufficient to protect against discrete, catastrophic price moves, also called black swan events. That will require a different type of hedge, which we will analyze and construct using the final components of the option strategy hedging and risk management spreadsheet. These new tools use VIX call options and SPX put options, or put options on the underlying security, to hedge black swan events. Before we can review the option hedging tabs, I need to provide a brief overview of the process, which should make it easier to follow the spreadsheet demonstration. The objective of the black swan hedge analysis is to calculate the total dollar cost of the option hedge per trade day for a list of weekly and monthly VIX call option and SPX put option candidates, and find the candidate that offers the lowest cost black swan hedge solution. This analysis is always done with real-time prices to ensure that we can actually implement the final solution. There are two option hedging spreadsheet tabs. The VIX Call Hedge tab is used to evaluate and calculate the cost of constructing a black swan hedge using VIX call option candidates. The EQ Put Hedge, or Equity Put Hedge tab, is used to evaluate and calculate the cost of constructing a black swan hedge using put options on the underlying security, which will be SPX in this example. The format and mechanics of these two option hedging tabs are almost identical. As a result, I will focus primarily on the VIX Call Hedge tab in this demonstration video. There are 6 principal elements of the two option hedging spreadsheet tabs. The first element is the Hedge Objective, which is the average profit the hedge will generate in the black swan scenario. For example, if we had a $100,000 position or $100,000 Reg T requirement for an iron condor, and we were willing to lose a maximum of 20% on that trade, then we would need to hedge the remaining 80%. In other words, in the event of a black swan scenario, if that actually went to zero, our position went to zero, the hedge would need to generate a total profit or an average profit of $80,000 to ensure our maximum 20% loss. As you'll note, the hedge objective is specific to the option strategy itself. Number 2, we would also need to define the catastrophic risk event. In the case of using VIX call options, we'll need to define the magnitude of the VIX index increase in response to that catastrophic risk event. In the case of SPX put options, we would need to define the percentage decline in the SPX index, also in response to that hypothetical catastrophic risk event. Number 3, we would need to provide market data for analysis, specifically real-time prices, the analysis date, transaction costs, etc. All the information that we would need to evaluate the options and the candidates that we're going to use for hedging purposes. Number 4, we also need to perform option valuation on the market data information itself. So once we have the market data and the assumptions with respect to the catastrophic event and our objective, we can value the options in the current environment. That will give us implied volatility data, also tell us the structure of the implied volatility in the marketplace. We will combine that with the specifics regarding the black swan scenario, and then from that we'll be able to calculate both the option values today, but also the option values in the future in the case of the black swan event or the catastrophic event actually taking place. So that will provide real market data and forecasted market data on each one of our candidates. Once we know the expected future option prices in the event of that black swan scenario, we can calculate number 5, which is the actual hedge solution, which represents the number of option contracts that we would need to purchase for each one of those option candidates. Once we calculate that, that'll also tell us the average cost of maintaining that hedge for each one of the candidates as well. And then finally, once we know the hedge solution, again the number of option contracts for each candidate that we would need to purchase, we can perform a form of scenario analysis, which would actually tell us the minimum, the maximum, the average profit, the range of profits over a number of different black swan scenarios. So with the objective in mind, which again is to calculate or find the candidate that offers the lowest cost black swan hedge solution, and the specific spreadsheet elements in mind, let's proceed with the spreadsheet demo. There are 6 tabs: Terms, Holidays, Position Size, Futures Hedge, VIX Call Hedge, and EQ Put Hedge, Equity Put Hedge, all located at the bottom of the spreadsheet. This video will deal exclusively with the Terms, VIX Call Hedge, and EQ Put Hedge tabs. The first step is to accept the terms and affirm that you have purchased the article. This is accomplished using the drop-down boxes on the Terms tab of the spreadsheet. The disclaimer on your screen also applies to the video. Now we are ready to use the VIX Call Hedge tab to solve for the lowest cost VIX Call Hedge solution. All of the videos only provide a simple demonstration of how to use the spreadsheet tools that accompany the article. In the article itself, I provide a much more detailed and comprehensive discussion of the framework and methodology used in the spreadsheet, including several of the formulas. Cells with blue backgrounds represent user inputs. All other cells are calculated by the spreadsheet. The hedging screen cannot fit entirely in the video window. As a result, I will occasionally need to use the arrows to move left or right in the Excel window. The cell window is split to facilitate that movement. The first thing you'll notice on this tab of the spreadsheet is the word value with an exclamation point located in a number of the calculation cells. These do not indicate errors. The reason the word value with the exclamation point appears in those cells is because when I opened the spreadsheet, we had not yet accepted the terms. So as a result, by accepting the terms and then running a calculation on the spreadsheet itself that will force all of those cells to repopulate is the easiest way to get rid of those value messages. So in this case, on this tab, and also on the Equity Put Hedge tab, the easiest way to do that is to click on the Clear IV macro up in the bottom left-hand corner. This reinitializes all of the values and allows you to start with a clean slate. So the next step in this process is step number 1, which is to define the hedge objective. So I talked about that briefly before, but the hedge objective can be defined up in these 2 cells, so cell D4 and D5. And you can see here there are 2 values that are required. So the first value that is required is the 106,712, which represents the size of the position, so the Reg T margin amount. And the 80% directly above it says that we need to hedge 80% of that position. In other words, we're willing to accept a 20% loss as part of our normal iron condor strategy, which is what I talked about in an earlier video and also in the article itself. However, we still need to hedge 80% of that value. And as a result, that is going to be our hedge objective. So the objective for the hedge is to generate an average profit of 80% of $106,000, or approximately $107,000. So the next step, after we've defined the hedging objective, is to define the catastrophic risk event itself. So specifically, in the case of the VIX index, we need to define how much the VIX index would change in the event of the hypothetical catastrophic risk event, or black swan. So in this particular case, I won't go into the details of how I derive that number. I discussed that extensively in the article. But let's say hypothetically that we were expecting the VIX index itself to increase by 45 points. And as a result, we would then use that in our analysis of the hedging vehicles. So those are the first two steps. We've now defined the hedge objective, and we've specified what the catastrophic risk event is. In the case of the S&P put options, or the equity put hedge tab, we would actually be defining the percentage change or the percentage decline in the SPX index. In this case, we're talking specifically about an increase in the VIX because the VIX is inversely correlated with the price of the underlying instrument. So now we've defined the hedge objective, we've defined the catastrophic risk scenario, or the change in the value of the VIX index itself. The last element that we need before we can begin the analysis is to provide market data. So first, we need to define or provide the information on VIX futures. So the VIX futures expiration dates are listed here and are automatically populated by the spreadsheet itself. So it begins with a series of weeklies, and then it moves on to the monthly VIX futures. And then in addition, for each one of those candidates, we need to provide the value for the VIX, the current value, the real-time value for the VIX index itself, as well as the real-time mid-market values for each one of the VIX futures instruments. So you may ask yourself, why are we providing information on the VIX futures when we're going to actually use VIX call options to hedge? The reason is that VIX call options are priced based on the term structure of the VIX futures market. As a result, anytime that we evaluate or analyze options on the VIX index, we need to actually input data on the VIX futures market. So once we've done that, we need additional information on the VIX call options themselves. And that can be seen here. So in this case, I've actually highlighted the hedge NC column. That's actually not correct. That's something that's going to be calculated later. But we do need to provide the strike prices for each one of the options, each one of the option candidates, so 14, 18, 20, 22, 24, 25, and so forth. And then we also need to provide the ask prices, in other words, where we could actually buy those securities in the marketplace. So a nickel, 10 cents, 15 cents, 65 cents, and so forth. And then finally, there's some additional information we need to provide with respect to market data. So up at the top of the spreadsheet, we need to provide the risk-free rate in cell D2. We need to provide the average bid-ask spread for the option candidates themselves, which is 10 cents. And then finally, we need to provide the analysis date, which is the real-time analysis date of 2/27/2017 in this case. Finally, there's one additional piece of information that we need to provide in the analysis, and that is the average number of holding period days that we expect to need this hedge for. So in other words, if we expect to hold the iron condor position for, in this case, 33 days, that's the value that's entered here. No, that is not the expiration date of the options. That's only the expected holding period for the strategy itself. So we've completed the first 3 steps in the process, but the macro sequence will now be used to automatically calculate the final 3 elements. So number 4 would be option valuation, number 5 would be hedge solution, and number 6 would be scenario analysis. So here's the macro sequence. As I already mentioned, we start with clearing the implied volatilities, which we've already done, but I'll do that just so the steps are consistent. So we clear the implied volatilities. We then calculate the implied volatilities from the prices. That populates the implied volatility values. And then the next step is to run the macro that says populate sample hedge values. So what that did is it actually filled the column in I8 through I19 with a sample value of 10 contracts. So we don't know what the final solution is at this point, but we need some positive number there in order to complete the calculations. The next step, we can calculate the average VIX change profit. So in other words, the average profit from the hedge in the specific VIX scenario, Black Swan scenario that we've defined. So we use the 10 contracts to calculate the average profits, which are showing up on the right side of the spreadsheet, which we'll get to in a minute. Now that we've calculated the average profits, we're going to recalculate the number of contracts in the hedge using those values. And that's done by clicking on the Calc Hedge number of call option contracts macro. So we click on that, and as you can see here in column I, it has now populated the values in column I with the specific number of VIX call options that would need to be purchased for each one of the respective VIX call option candidates. So in this case, it's 21.5 for the first, 27.0, and all of these numbers are rounded off to the nearest, to the 10th of a decimal point, just to provide an additional level of accuracy. Obviously, trading-wise, we would have to round those off to the nearest integer. So the one additional step is once we've calculated the final hedge solution, meaning the exact number of contracts we would need to purchase to hedge the solution, we need to calculate a new set of average profit levels for those specific final hedge solution or the specific final number of contracts for each one of the candidates. And so again, we click on the calculate or the calc average VIX change profit macro for one final time. Again, that completes the analysis, and then that generates all of the data that we'll review going forward. Now let's review the actual hedge solutions and scenario statistics for the final hedge solutions for each one of the option candidates. Now that we've completed the analysis, or the spreadsheet has done all of the calculations for the hedge, the first thing I wanted to point out is that the spreadsheet calculates the ending VIX futures value that is specific to the Black Swan hedge scenario. So in the case of the VIX index, it actually has the VIX change going up by 45 points as we've specified, ending at 56.88. Similarly, for the weekly options, they go up by 44 and change, 34 and change, 30, and so forth. And the terminal values for the VIX futures contract are listed here for the specific scenario that we're looking at. I'm now going to shift the spreadsheet to the right, or space over to the right, which will hold the left-hand side of the spreadsheet constant, and then we'll look at the remaining analysis cells for the spreadsheet calculations for the hedge for the VIX call options. So the next thing I want to look at is the section of it on implied volatilities. So the spreadsheet used the initial market prices to solve for the initial implied volatility, and then it used the specific scenario that we forecast for the VIX going up by 45 points to calculate the ending implied volatilities in the no change scenario, meaning without the change in the VIX and also in the VIX change scenario. From that information, it was able to solve for the no change and VIX change scenarios with respect to the prices of each one of the call option candidates. So these are the terminal prices for the VIX unchanged environment on the left side, and these are the terminal call option prices for the scenario with the VIX going up by 45 points. So we've calculated the implied volatilities. The spreadsheet has then gone and calculate the scenario prices in the unchanged and the black swan scenarios. And then in addition, it calculates the specific call option profit for the specific number of days in this example, which is only 15 days. On the 15th day, in other words, is when that actually occurs. I describe this in much more detail in the article, but I don't want to go into more detail of it here. And most importantly, it calculates the average profit for each one of the candidates using the final hedge solution. So what you'll notice is the average profits are almost exactly equal to $85,500. And the reason is because our target was to generate a 20% profit on that approximately $107,000, which equates to approximately $85,500. In other words, the specific solution or the specific hedge solution for each one of the call options was derived in such a way to generate that average profit. But more importantly than that, and the reason for doing this whole analysis using actual market prices, is to calculate the total cost of hedging, which includes all transaction cost, including round-trip transaction cost, for each one of the VIX call option candidates. So based on the final hedge solution, we see that the first option candidate had a total transaction cost of $61 per day, in other words, per trading day. The second candidate had a total cost per trading day, total hedging cost per trading day, including transaction costs, of only $22. That was actually the lowest and most cost-effective VIX call option candidate across the board. So again, the whole purpose of this exercise was to use actual market prices and a specific hedge objective and a specific VIX change scenario or black swan scenario to find the lowest cost hedge solution, which we have done in this case. So the lowest cost hedge solution is to buy the VIX call option that matures on 3/8/2017. And for more information, I will again space over to the left-hand side and highlight the candidate again. So again, the optimal solution is shown here, which is to purchase 27 contracts of the VIX call option of the $18 strike that matures on 3/18/2017. The ask price is a nickel. So that would be our initial hedge. Obviously, if we expect to hold that security or maintain that hedge for 33 days, since this security matures in only 7 days, we would need to repeat that hedge repeatedly as long as we maintain the underlying iron condor position. But all of the calculations are done on a per day basis, and they are designed to maintain or repeat that hedge as necessary. So we've now completed the analysis and identified the lowest VIX call hedge solution. But let's page over to the right and look at the scenario analysis that's available for each one of the VIX call option candidates. So for each one of the candidates, the scenario analysis calculates the average profit, which we've already talked about before, but it also calculates the minimum profit, the maximum profit, and the profit range. So specifically, what that information is related to is we do not know exactly when the black swan event will occur. If you will recall from the example, we're going to hold this position for, on average, 33 days. So it makes a significant difference whether the black swan event occurs on day 1, on day 15, on day 33. So as a result, the analysis looks at each one of those days and calculates the minimum, maximum, and the range, as well as the average profit for each one of the candidates, assuming that the candidates are continued rolled into new positions as needed. So that completes our analysis of the VIX call hedge. Let us look extremely briefly at the equity put hedge page, and you'll see that it looks almost identical in structure, and the mechanics are almost identical to what we just completed for the VIX call hedge. So we'll not go through this in detail, but let's quickly go through the analysis and complete the process to generate the solution for this page. So we start clicking on the clear IVs. We calculate the implied volatilities, we populate the sample values, calculate the average profits, calculate the initial hedge based on those average profits, and then finally recalculate the average profits based on the final hedge solution. So if I page over to the right, exactly as I did before, I can see what those final costs are for, this time, the S&P put option candidates. And as I can see here, the lowest cost solution for the put option candidate is actually only $9.6 per day. That actually compares favorably with the VIX call option candidates that we just calculated in the previous hedge analysis. So we always have the option of either using VIX call options or put options on the underlying security to hedge ourselves against black swan risk. And as a result, we are looking for the lowest cost solution. And then in addition to that, we can also page over and again look at the scenario analysis just as we did before, and those values are listed over at the right hand side. And again, we can look at the average profit, we can look at the minimum and maximum. You'll see here that the profit range is actually smaller in this case. So we have a lower cost solution that has a much narrower profit range, and as a result, that solution, at least in this particular case, dominates. So we would actually prefer to purchase the put options on the VIX index as opposed to, put options on the S&P index as opposed to the call options on the VIX. All right, so that completes our review of the hedging tabs. Let's review the several resources that you might find useful in your trading and research. My first 3 option books are listed at the top of the resources page. If you are interested in learning more about these publications, you will find Amazon links for each book in the right sidebar of the Trader Edge website. All books are available in print and ebook formats on Amazon. On TraderEdge.net, you will also find blog posts, links to discount offers from affiliates, all of which I use in my proprietary trading. Finally, Trader Edge offers a monthly subscription to the OIS Universal Filter, which is a proprietary algorithm that is used to objectively rank entry and exit environments for option income strategy, or OIS, trades. The filter is discussed extensively in my recent publication, Option Income Strategy Trade Filters. I hope you found this demonstration helpful. If you have any questions, you can contact me via email at bjohnson@traderedge.net. Thank you.